Okay, everyone, we're going to kick off the next section. We have Josephine Bush is going to chair a panel discussion about nature, investors, and communities. Over to you, Josephine.
Thank you very much. Good afternoon, everyone. As Rich said, I'm Josephine Bush, and I've got the great pleasure of chairing this panel. Before we get going, I thought I'd remind you of the question that's the heart of our discussion today, and that question is, can large-scale nature investment deliver credible returns for investors while genuinely benefiting communities and the environment? So investors need double-digit returns over the long term. Communities need economic transformation, not consultation theatre. And the environment needs actual restoration that is both permanent and measurable. So the conventional wisdom says that you optimize for one, maybe two, but never all three. Our panelists today believe something different, that these three aren't trade-offs, that this three-legged stool, if you like, needs to be in balance as they are interdependent themes. Now, we've got practitioners here who've deployed capital, advised communities, and measured ecological outcomes. And they will tell us what is real and what is wishful thinking. So I'm joined by Darren Ward of the West Yorkshire Pension Fund, McNab Laurie, a community representative, and Richard Kelly, who you've already met today. So let's find out whether the three-legged stool can stand up, or whether we're building elegant justifications for doing one thing well and other things badly. So Richard, can we start off with you, if we may? Could you set the scene for us on the scale of the challenge as it relates to the need for natural capital investment?
Yeah, absolutely. So I mentioned at the beginning, we're facing, as a planet, twin climate and biodiversity emergencies. And Partha Dasgupta, in his book, talked about that society, the world as a whole, is environmentally overreaching. And we would need 1.7 Earths in order to satisfy the sustainably demand for the commodities and what we use our natural capital for, which is a staggering statistic on a sustainable basis. So we are fundamentally environmentally overreaching. And according to the UN, and there is an $8.1 trillion investment requirement in order to restore nature into that sustainability and to achieve net zero by 2050. Now that is a staggering figure, and even if we were to put all philanthropic capital, every pound of it, towards climate and biodiversity, that would represent less than 10% of that total 8.1 trillion figure. So the conclusion of that then is that the remaining 90% of the solution, it must be profitable. It must compete with anything else that investors could put their capital towards. The challenge is that natural capital has been competing historically with one arm tied behind its back, in that natural capital and the services it produced have been fundamentally undervalued or not valued at all. You know, carbon sequestration services that are provided by New Forests, it's only relatively recently that there's been a carbon value placed on that. The pollination value of insects, again, just fundamentally doesn't get valued. And so that is the challenge. How can natural capital compete with one arm tied behind its back, given the scale of that challenge?
Yeah, I mean, Dasgupta also talked about, institutional failure, market failure, and regulatory failure in the build of this market. So let's try and unpick that a little bit. I mean, can you talk to us about, or give us an overview of the different types of return that you see building within natural capital investments and what those return expectations are that might help incentivize capital to flow?
Yeah, so there's kind of broadly three buckets of natural capital investment. There's the traditional natural capital investment, which I would characterize as passive. So think of your traditional timberland funds, your traditional agricultural funds. These strategies tend to own the land, hold the land, and sell the commodity, the goods, whether it's timber or food that's being produced, and then the asset is exited over a period of time. So these kind of strategies typically deliver sort of mid-single digit type returns. Good inflation protection, but not particularly exciting from a returns perspective, but it is asset backed. You've then got the second type of natural capital investment, which I would characterize as proactive natural capital strategies. So these are strategies which are actually all about land use change and land use enhancement, a proactive intervention. With these strategies, they're generally asset-backed still, but there's generally a capital appreciation opportunity as the land is converted from something that's lower value into something that's more valuable. So there's an additional capital appreciation opportunity. And these types of projects also typically unlock things like carbon credits and biodiversity credits as upside revenue streams. And then those sort of projects are delivering generally low double-digit type returns. And then at the sort of most risky end of the spectrum, you've got the kind of pure carbon credit or pure credit plays. With these, the returns are in the high teens, sometimes up into the 20s, but there's no asset backing. It's purely about future demand for credits and where those prices might go. So there's a real variation of the different types of natural capital strategies and the returns that are available.
Yeah, and given the sort of level of uncertainty we have in the market around, say, policy, verification, methodologies, liquidity, etc. You've described positively what sounds like a revenue stack. Haven't you really just described a risk stack?
Yeah, those things are also risks. Yes, there is a risk, particularly with carbon markets, as we've just been discussing. It typically is a merchant strategy. There isn't a fixed price available for carbon, and so yeah, there are significant risks associated with that. Community risks as well. When you're undertaking land use change at this sort of scale, community risk is definitely something that needs to be considered.
And isn't that just venture capital then, dressed up as infra?
I think the first two strategies, so your traditional natural capital and then your proactive natural capital development, I would argue not, because it's still involved. It's still asset-backed. It's still ownership of the land. But when you're getting into those pure kind of carbon credit, pure credit plays, yes, that is more akin to venture capital type risk. And it's certainly a similar types of returns, 20% plus type returns.
And you talk about the asset backing. Can't that be wiped out if you do have a climate catastrophic event? So it's a bit like writing a naked put option.
Yeah, I think if you on the pure credit strategies, I think if you own the land, yes, the crop can be destroyed. Your forest could burn down. There is insurance available for that. If you're growing food, again, your crop could be destroyed. But if you own the land, that land still has an inherent value, and you have the ability to replant, restock, and recover, even in a kind of a catastrophic type scenario.
Darren, could I pull you in here for the institutional view?
Yeah, I like your VC infra analogy. We sometimes get scared to use sort of VC language, profiting from nature and things like that. I think we have to remember that, and societal gain and all that, investors are society. It's not like investors over there and society there. We're all part of the same thing. And investors need to be part of the solution, as Rich mentioned there, was it 8.1 trillion? Government's not going to come to the rescue on this in terms of that amount of capital. Sure, they can provide regulation, they can provide tax incentives or subsidy or pump priming or first loss capital, all that, and that's vitally important. But to get to the scale point that was mentioned earlier, it's going to require pension funds and asset owners who can commit that sort of capital. and provide returns for their pensioners. They're not pocketing the returns for themselves, it's for their pensioners and savers. You know, return doesn't necessarily mean extraction. Return means adding value. Return means rewarding risk. And why don't we take the best bits, the best parts of venture? You can still invest in the natural capital space and you know, be a venture type investor if you want to invest. Why not? We're an innovation economy. You know, we've got the third largest pension pot in the world. We've also got the third largest innovation economy in the world. Why don't we take advantage of that and start to think about investing with these companies, either in these companies or alongside, with that VC mindset? But today we're talking more about land use change and it as a real asset. You know, I think of it, we invest in infrastructure. I think of it more like value-add infrastructure or innovation-led infrastructure. These are real assets with real cash flows, with inflation protection and low correlation, yes, but they also is that upside potential of carbon credits or BNG or payment for ecosystem services. So I think as investors are part of the solution, deploy capital, have impact on the economy, on environment and socially, to then provide those resilient long-term returns for our members and our pensioners.
And if natural capital is contributing globally to GDP at circa 4-5%, I think they're the sort of figures, why is institutional capital only at about 0.2%?
Okay. You know, just because a pension fund shouldn't base its asset allocation based on what proportion is invested in a country. There's lots of other reasons for why a pension fund invests. You know, if that was the case, we'd be investing 60-70% in SMEs. That would be slightly risky because that's what they provide to GDP in some places. But I take your point. We're massively under invested, as the Dasgupta review mentioned, and everyone in this room knows and understands. There's a whole host of reasons that the previous panel mentioned and everyone understands. This is a nascent industry. I know the carbon credit market might have been around for 20 years, but in terms of its professional and its evolution, it's very new. It's very nascent for investors to understand. That's okay. And teams might not have track records. They can't come through to an investment house and say, here's my 5 and 10 year record. But these teams are highly skilled and they've been successes in whatever previous work they've done. Timescales, sometimes there's a mismatch, and we're talking very long-term investments, talking about 100-year profiles for forests. Some investors need liquidity, so there is a mismatch there, but there's enough long-term patient capital across the globe to invest in this space. I think there is still a perception that a lot of this is impact first and returns secondary, which we need to get over. And I think Rich's point earlier about success stories, we need to talk more about them, the financial success stories. There are MRV challenges, but I think a lot of that is rear view mirror. I think what's happened, the developments in AI and technology and companies developing their own proprietary tech stack to monitor, I think that's a future opportunity. And everyone in this room will know more about that than I will. I suppose the 2 points that I suppose I could add some value on is the asset allocation conundrum that people talk about is where do we allocate this to? It's not quite infrastructure, it's not quite property, what is it? And the scale point. On the asset allocation point, you know, I actually heard this argument years ago about data centers, because it's not quite infrastructure, it's not quite real estate. But I don't see any problem in people investing in data centers now. They, you know, you can find a solution, and it was mentioned earlier about the global timberland funds. I think there's 3 global timberland funds launched last year and the year before, all $1 billion plus. One was $2 billion, and that's in the natural capital space. I know it's global timberland. But again, they didn't find a problem with investment firms or asset owners saying, I don't know where to allocate it. You solve for that later. What the big difference is those were scaled products. Those were, like we said, £2 billion. The first raise might have been 500 million. That gets pension funds interested because, across the globe, but particularly in the UK, the landscape for asset owners is consolidation. We've seen it in private and wealth management, we're seeing it in DC, and now we're seeing it in local government pension schemes, where these are all now 50 billion plus assets under management. They're thinking of writing ticket sizes of 50 million, 100 million, 200 million. And, some people might find that a little bit scary, that because I know a lot of projects are small, and there's some wonderful projects that are small and they will provide benefits, but to achieve that $8 trillion gap, we need scaled products that provide economies of scale. The challenge is huge, and therefore I think the product needs to be a scaled product to entice global large funds like ourselves.
McNab, if we could bring in the community perspective a little bit on the value proposition that we're talking about here, what do you see as that for communities, and how they then relate to investors bringing these natural capital solutions to life?
Well, yeah, thank you. So yes, I'm down from Dumfries and Galloway, and we've got 20% of Scotland's peat estate. We are absolutely on the front line of afforestation in the UK, and so it could be seen that somewhere like Dumfries and Galloway could be seen as a sort of engine room of everything we've talked about today in terms of natural capital revolution. But obviously that's not how it's coming across to the local communities at the moment. It's a big spoiler alert. That's not how it's coming across to the local communities. And I think what's quite interesting is hearing how what we've been doing in my day job recently with the Dumfries and Galloway Woodlands charity is trying to explore how can we add value. I love that phrase, add value. If it's coming to Dumfries and Galloway, how can we add value? We have some real challenges in our area. How can we use these projects to align and maybe address some of those challenges? So you talked about adding value. We're looking at adding social value, that's public access angles, economic angles, so training, employability schemes, and through to the ecological aspects as well. How can we add value? I think that's a more positive discussion to be had, which is, if it's happening, how can we add what the local community sees as those challenges and add values to respond to that.
Thank you. So Richard, this sits against the backdrop of the great land transition, if we can call it that. Land use is changing at scale. Incentives, food security, ecological drivers, we've talked about all of those. Can you talk us through some of the practicalities of land use change? Is it inevitable, and who gets to decide where we land on this?
Yeah. So I don't think the market decides. I think a particular parcel of land, a farm, for example, the starting place might be, okay, what's its potential as a forest, or a potential to have its peatland restored? And you look at things like timber price, you look at things like the carbon price, the cost to acquire the land. That's the starting place. But it's not inevitable. I think what the solution that ends up going on to that particular project is negotiated. And it's a negotiation between what the investor wants and what communities want. And in terms of practicalities, it's about when we acquire a piece of land, it's about going and actually presenting the proposed change to communities and listening to what the feedback is. And the kind of objections that and concerns that could be raised, they are very wide in their scope. They can cover everything from my view is changing, you're changing the shape of the rural economy, what's happening to jobs, connectivity, you're changing the view of my neighbour, and so what the optimal solution for each individual farm is completely bespoke to whatever the requirements are and the voices of the local community. And so, as I say, the project that gets planted, or the peatland that gets restored, whatever happens, it's a negotiation of the economics and working with communities.
And that strikes me, looking at this community issue, McNab, through a sort of financial lens, but there's an on-the-ground reality here that you're on the front line of. Do you think investors genuinely understand the rural way of life and the significant social and economic impact of land use change and what this means for families, farmers, and local communities?
It's very very difficult to speak for 150,000 people in Dumfries and Galloway. This is not an elected role, I should stress, that I've adopted today. But just in terms of how, I loved your point before, Darren, about actually investors are actually part of society. In many ways, actually local communities, you can start to other local communities a little bit. If you say local communities too much, you sort of think, makes you think of pitchforks or people who still pointed aeroplanes and things like that. And actually, no, we are all communities. We're all in local communities, whether that's how we all see community dynamics. And so I think it's very, as a starting point, when you ask a question about how does the community engage with this, it's a good thing to remember that communities are just people, and some of them are smart, savvy people who do not like being managed, and I think it's the management that comes across, which has got to be really carefully angled, because if it comes across like people are being managed, you think, does a community like being managed? And I think, no, it's just people, and no, people don't like being managed. So it's a good reminder to start and say communities are all just people. If you're asking me, do I think investors understand a rural way of life? I just think what's coming across now in Dumfries and Galloway is how much it varies between different investors. And I think the communities, having said I wouldn't use the word communities are savvier and more switched on to this whole process than they were 10 years ago. And I think a lot of technology has developed, a lot of the processes have developed, but community engagement has stayed relatively static. And so I think the communities are starting to not only pick out how to handle an approach, but they're starting to find their way with different companies. And I think that's quite interesting, because then you start saying, don't let the worst of it define this. Is there an angle here to try and add value or add a differentiation, really, to what you're doing? Does that go any way to answering your question?
Yeah, absolutely. And I suppose you've sort of got shifting valuation sort of paradigm here, haven't you? You've described a revenue stack earlier that will drive or attract capital, but for communities on the ground, there's real impact with that. Do you think local communities have to accept a certain amount of loss or certain trade-offs?
Well, there's an unspoken thing about all the projects we're talking about here, is that I think the benefits are often delivered on a national scale and the disbenefits are delivered locally. And I think if you start the discussion from that position, that is a much more functional conversation that you can have. Because I think what's landing very badly in Dumfries and Galloway at the moment is that you've got to support this because of net zero. You've got to support this because of the national ambitions. And I think the perception slightly is that if you don't support this, it's because you're against net zero. And that's not the case. It's people don't support it because of the local impact on it. And I think it's quite good to have a discussion to say, this is what's happening, will deliver benefits on the national stage, and let's have a discussion about how this will impact you. And are there angles where we could use this project as an opportunity to address some of the challenges you're facing?
Richard, can we just look at some of the aspects of getting this wrong? Good community engagement, I'm sure, adds value, but ineffective community engagement can erode value and impact IRRs, discount rates. Can you say something about that and give some examples?
Yeah, absolutely. So, we recently exited a property, a newly planted forest called Bank Farm, and we delivered a 15.5% IRR on that exit over a 4 3/4 year hold period. And that process went relatively smoothly. There wasn't, we didn't have any major issues with the community. There were no community delays. So that was a sort of a case study of what it looks like when it goes well. If the community there had been some issues that had come up, the community would have had the ability to delay the project. It would have taken us longer to secure planning permission and secure the grants, which are essential to the economics. And a 1 to 2 year delay erodes the IRR from, let's say, 15.5%, could be by 3 to 6%. That additional 2 years of consultation, redesign. So that's a sort of a delay. And to the extreme is, if ultimately that the project just gets completely unapproved, you don't secure the grant and you don't get the planning permission, which is what you need in the UK. Ultimately, you could be looking at potential losses. You bought the land with an expectation, a hope value of carbon and future timber revenues. If you can't complete that land use change, you could be looking at negative IRRs. So it is really important. I think that's really extreme, and it's quite rare where projects, investors wouldn't have done their full due diligence. It's very rare when a project doesn't go through. But I think the real risk, the most likely and impactful, is the risk of delay.
And how do you build that in then into project finance fundamentals and take that risk assessment and derive a figure that you're prepared to contribute towards community benefits?
I mean, I think our whole perspective is that social license is the difference between land use change happening sort of sporadically and subscale and having the social license and being able to do this at scale. And I think that's our perspective. And I think we're not necessarily talking about a cost or an erosion to IRR. Actually, it's about the way that you talk. It's about meetings, drop-in sessions in community halls, where you air all of your plans and you take feedback and you make relatively minor adjustments. It doesn't necessarily cost and hit the bottom line, or if it does, it can be immaterial. And so it's actually more about an approach and listening, and where the feedback is valid, being humble enough to say, oh yeah, okay, we weren't aware of that. We got that wrong. We'll change it. And it doesn't necessarily hit the bottom. There can be projects where it does, but I think most of it is about, and it's an approach and being flexible with communities.
I mean, I think we've seen a lot of examples in infrastructure where it has hit the bottom line, where there have been costs of delay can be very significant. From your perspective, Darren, how do you assess this community risk in particular, and how might it feed into your valuation models?
Well, I'm not going to go to community halls and be shouted at for 2 hours, put it like that, but I've got enough shouting at home. It's a huge risk, and I think, this is what does put, let's be honest, it does put investors off. It does put pension funds off, particularly arguably the closer to home it is sometimes, and that's why you probably see more Canadian funds investing in this sort of thing than you do local government pension schemes, arguably. And I wonder, I don't know how much difference it would make, but I wonder in those situations how much difference it would make to local people to see the local government pension scheme being the investor and realising actually this is how it works. This is, there will be a financial return. We shouldn't be afraid to talk about that. But that is going to pay the pensions of teachers and nurses and hospital workers and librarians, etc. And I think it just paints a better picture of how things are built in this country, how things are recovered and improved. But it's also a reputational issue for us as well. I mean, it hasn't. We do invest in infrastructure, we do invest in housing, and I actually think as pooling and funds become more scaled, more sophisticated, can build bigger teams, I think there'll be more appetite to invest more directly into schemes like this. Because there's always this, when you're small funds, there's a tendency just to use the fund manager, and you hide away as a minority LP or shareholder, and if it blows up, you're not too exposed and you don't face the reputational risk. Now, when you start doing more direct co-ownership, yeah, there's more reputational risk, but you ensure that there's more governance, you ensure that there's more accountability, and I think that makes schemes more durable over the long term, perhaps.
Now, I've given some of the risks we've described. Can you talk us through what good community engagement really looks like and give some examples?
Yes, I've got a short 45-minute presentation I can provide on that subject. But just to come back very quickly on Darren's point there, I think how do local communities, to what extent I can speak to local communities, but how do local communities see pension fund investors? I think that is something that there's a story that's really not reaching people about who's making money out of this project, and this is actual pensions that people know and relate to. We've got projects in Dumfries and Galloway now who the agent is unable to say who the owner is. So it is the baseline is much further from that. I think the discussion about, who is the owner, that's a great discussion to be had, because some of the discussions are, well, we can't talk about who the owner is, and that just comes across really badly, obviously, on a local basis. So in terms of your question, sorry, which was what have I seen in terms of good examples of community consultations, I have another hat, which is I'm a secretary of a community council. So I'm the first port of call for a developer to come into the region. So, and just to say behind the scenes as well, that's not a role I've sought, Secretary of Community Council. This is not something I'm fighting to be. This is something I am until I can find someone willing to take on the role. And I give you that little bit of colour just because I want to say that sometimes I think community councils, you can think that these are people who have devoted their life to fighting things off or arguing things, but I want there to be a community council. I want it has usefulness when it comes to weather events and resilience and holding the community together. And I think now something like a community council, it's being seen slightly as a sort of a roadblock to get over or something like that. But when you get in, there are actually people who are trying to do the job the best they can. And so it's an interesting thing just to give a little bit of flavour. Also, any applications for secretary is very welcome. But in terms of good community engagement, I mean, there's so much I could say that it is an art form. Community engagement is an art form, and it is almost an alchemy that if you look directly at it, you can kill it. It is because you don't want to come across in a way that you are managing or manipulating people to their input into this. But there is a way, and I need to say it here, there is a way that communities can benefit these projects. There is input from the community that can improve these projects in terms of productivity, in terms of bottom line. And I think that, yes, that is difficult to get to, but that should be kept as an ambition, because there is a way that local input can benefit these projects.
What's the right governance structure for that then, and the right type of payments?
Well, that's just absolutely fascinating. So yeah, so we have there's so many different angles to take on that. I think you need to work at that the community is not really represented by any single group or organisation. I think different communities have different roles, or different parts of the community have different roles. So something like a community council is there to represent people's views. And if people coming to that community council meeting saying, well, you've got to reject this, you've got to reject this, then that is about as far in terms of creative thought that community council can get to. So and then you get other organisations, like I happen to say is working for one myself, which is sort of regional focus, which is a little bit more robust and represents communities on a broader basis. And I think you have a space for formal engagement and formal planning discussions, and then you have a space for creative adding value thought. And I think those two can run as two separate tracks. But I think you shouldn't restrict yourself just to entities and organisations. I think there has to be the public, absolute general public engagement. And also, I want to say a word about consultation fatigue, because there was the first person who did a consultation was a genius. What a great idea to do a consultation on something. And then over the years, that has just been, we have such a lot of consultation activity going on, particularly in Dumfries and Galloway, pylons, wind farms, afforestation projects. There's so much going on at the moment. I think there is a real risk that the bandwidth for communities for reasonable thought is even pushed harder, because there's just so much parking charges in Falkirk. What do you think about this? There's a lot of consultation fatigue. So you asked me 20 minutes ago, what have I seen as good community engagement? I have seen, it really does come, I have seen a massive variation. Some operational points it's so much better when the owner or developer is able to lead the community engagement work. And so when you see other people who engage a PR company to run the community engagement, it just reeks of, we need to manage the community engagement side of things, and to have an owner or someone closely involved in the project being able to engage with the community on it, I think adds so much to it. So, and then even so operational things like having the same person for a long period of time, don't have a churn of staff as the lead contact. But yeah, ultimately we're talking about really difficult skills of empathy and trying to understand how can this project address some of the challenges that people face. I think that's probably the most positive way to look at it.
And in terms of benefit, what's the most effective model? Is it cash benefits for various things that the community decides, or shared ownership structures, or a mix of both?
Fascinating. Yeah. You can't help but look at wind farms, because we're a little bit further down the road in terms of community benefit payments, which is just cash payments. And I think sometimes when looking at forestry, it's tempting to run to the cash discussion. But the benefits the adding value we've been working on, including with Foresight, is a mixture of on-site works, such as improvements to the asset for public use. So we're talking footpaths, signage, benches. It's about actual sort of quality of life, really, for local residents. And then you get the off-site works, which is even more exciting, which is how can you involve yourself in the local labour market? How can you boost supply chains that come from the project? And then the ecological work that is we're just really touching the surface of what can be done with that. So, yeah, I think the cash is we can learn from wind farms that wind farms that operate on almost entirely just cash basis. I think there are some real benefits in terms of who do I speak to about unlocking that gate? How do I? Those things cost nothing, and that's more of a relationship, really. I think. Probably.
So I'm going to ask one last question because we're running out of time. Start with you, Darren, if I may. I'll ask the same question to each of our panelists. What is the single most important ingredient for delivering land transition at scale?
Financial return, I would say that, wouldn't I? Coming from an investor background, but all at the top of the show, if you like, you use the analogy of the three-legged stool and the social and environmental. All three are obviously hugely important, but in order, the key is in scale. When in that question, to get to the scale we requires, local government pension schemes, DC schemes, sovereign wealth funds, the Dutch schemes, the Aussie schemes, all these multiple of £100 billion schemes to invest in nature and climate change solutions at scale. As the previous panel mentioned and Rich mentioned, that we haven't paid for nature enough to date, and we haven't got a return from it enough to date, and that hasn't gone too well. So don't be scared to make a return from nature. Rob mentioned earlier the success stories. Let's shout about the success stories. Let's shout about we've made an IRR of this, we've made a return, because that return is funding pensions for our members for years to come.
Rich, same question to you.
I would say social license is the single most important factor. I think the financial returns, yes, they have to stack up. It has to offer an attractive return, a risk-adjusted return to investors. But even if you have that, I think the community and social license, the ability to make this change happen in a way that is done with communities rather than imposed on communities, I think is the difference between the scale being sort of piecemeal, a few projects here and there, versus if you have the social license and you have local people on board with you, that's what unlocks this investment opportunity at scale, in my mind.
Social license, agree with that. I never thought I'd be calling on a buzzword as well. I think just transition is what I keep coming back to, because just transition, the principles of that is it's fair. And there's lots of things against you on that in terms of history of land ownership and everything like that. But if what you're doing can be seen as just and fair, then I think that's probably what's grinding most at the moment on the local basis, I think, probably. So I would put that in.
Thank you very much. Well, we're going to be able to take a couple of questions from the audience now, I think. But before we do, I'd just like to thank our panel for their insights. Thank you. We have a question at the front. Do you need a mic?
I can speak loudly.
Yeah.
I'm just wanting to sort of link the idea of scale that the investors need with carpet planting Sitka monoculture through big chunks of Scotland. Because if we're going to double, treble the planting rate in Scotland, and a lot of it will be Sitka, how is that going to go down with communities that are already very frustrated by the fact that the hills are just carpeted with dense, dark forests that no life lives in? I'm sorry, big doom and gloom about it, but isn't there a problem there?
Yes. Next question. Absolutely. And in the middle of that as well, you have a community which is getting smarter and better engaged and able to get involved in things, because I think things 10 years ago probably communities were unaware of as much as they are now. This is why when you hear the discussion, some of the discussion earlier on today, you start thinking this is an opportunity for us. Something like Dumfries and Galloway is an opportunity that's just so far from how people see it at the moment. And so I tell myself that if it's happening in Dumfries and Galloway, how can we add value to it? That's a get-out clause. That's what I've been focusing on, is if it's coming, how can we make sure this can start to tailor locally? But I think, the comment that would be made from within foresters is that it's not, projects now are not what were being planted 20 years ago, and there is an increased variety and increased species for choice and things coming in there. But I'm probably hilariously underqualified to come back on this particular angle. But,
I think communities rightly have very long memories of the sorts of planting that was happening back in the 70s and 80s. And we're talking about those kind of monoculture, pure Sitka plantations on top of the hill, no landscaping considerations. And I do think investing in planting has moved on a long way since then, but we can't dismiss that concern. We have to address it and talk about, sensitively designed forests that mix different species that, visually, and this is a big concern for local communities, is what does it look like? And, designing a forest that is surrounded by broadleaves that looks beautiful, and then the center of it is out of sight, out of mind, is the kind of the beating heart, the timber, where the timber production happens. So I do think that silviculture and forest design have moved on a very long way from those sorts of planting. But we have to take local people on the journey and say, look, this, I know that's what happened back in the 70s, 80s, but this is not that.
Should we go to the lady here?
Thank you. So I had two quick ones. So one was, can you give examples, and I think this is to you, Richard, on the middle bucket that you spoke about, so the land use change, which is still asset-backed, but the in-between, and where you've seen good examples. And I think because the first and the last, I think they're quite obvious. And I think the second question is about, there's a part that we heard about Microsoft, we're hearing about all these corporates buying swathes of land to, reforest and link to their credits and whatever the outlook is in terms of risk management. But I think it's about the local communities and how the power should not then again go to these big corporates owning most of the world or the land on the world. How are investors working with CDFIs and communities to actually have community ownership? So are there examples where community still owns the land, but investors have come and added value through other partners? So.
Okay. Yeah. So the first question about an example of what is proactive natural capital development. I mean, most of what we're doing in Foresight Natural Capital is proactive natural capital development. So our strategy is we hunt for pasture and grazing land that has become sub-economic. The subsidies have been tapered away. We can acquire that for maybe £10,000 a hectare. It varies on where it is and how productive the land is. And the strategy is to then proactively secure planning permission for the permanent land use change to forestry. We look to secure local government grants, which are available, that help help fund the capex of the conversion, and then we're physically planting a new forest. So through over several years, we've gone from a degraded piece of sheep grazing land into a productive forest that's sequestering carbon, and it's that's what I mean by proactive land use change. Land use enhancement, that might be in the forestry world, that might be taking a forest that was perhaps planted back in the 70s and 80s. It was one of these monoculture type forests, pure Sitka spruce, or it could be a pure pine forest, for example. And as and when those trees mature, we're then looking to harvest those and restock in a fundamentally more sensitive way, and planting forests of the 21st century. So that's what I mean by proactive land use change and enhancement examples.
But would regen agriculture, so it's productive land you're saying, but it is through the reforestation and the sequestration of carbon, or is it component of it is productive for whatever reasons?
Yeah, so I mean, there's it becomes productive land, so ultimately you'll be able to harvest the trees that are planted. You'll generate carbon credits, which can ultimately be sold to corporates for use for net zero. Our strategy is actually to facilitate the land use change, get the young forest up and running and established, and then actually we look to then exit that young planted forest and recycle the capital into a fresh wave of afforestation. And so we're that's our strategy, kind of operating in the kind of in the proactive development. And then, once the forest is established, we're then looking to hand that over to the next custodian of the land, who then is interested in, long-term ownership of a, sensitively designed forest. To answer your question.
CDFIs, yeah, thank you. It was obvious. I just want a clarification point. And then the working with local communities where land ownership still stays with the local communities. So Traders Bank has been quite active in this space and trying to do models similarly. I wonder where mainstream investors' head is at in actually growing, the CDFIs and community ownership and community financing. And if you're seeing any examples in yourselves, Aaron.
Yeah, so I mean, certainly we're seeing examples of that. I think the sort of examples we're seeing are more where there's a collaboration. So, for example, on one of our projects in Dumfries and Galloway, we entered into there was an area that wasn't suitable for afforestation, and so we entered into a long-term lease with a collection of people from the local community. And that area has now become a rewilding scheme. Children from the local school have been out to plant it, and so it's actually about optimizing areas that aren't purely suited for planting trees or for restoring peatland. There are lots of models like that, and McNab, you can probably touch on the other kind of community.
Yeah, so we haven't got we've got examples of pure community-owned woodland who are trying to manage it efficiently. I can't think of any immediate examples where an investor and a community have joint and embarked a project. It's quite exciting to think about, actually. There's not an awful lot of immediately community-owned land where I'm from, so it's not coming at it from a position of enormous community land holdings, looking for an investor to skill them up in how to manage it. But it's quite an exciting idea to think of community and investor working on something like that.
Finally, we'll just take a quick point from James, see what he does, and then we'll wrap up.
So I'm involved with the Highlands Rewilding Limited project up in Scotland, and there are 3 assets there at the moment, and each of them has a variation on community ownership. In some instances, the land has been acquired by us and then leased back to somebody who will manage the whole area on terms. In fact, they're quite strict terms that they've agreed to, so it has a regenerative agriculture angle. Others, there's one in the Western Isles at Tavy where the purchase has been leased back to a community organisation for at least part of the estate, but again on terms that it's managed in a certain way. And each of the properties have been developed in some way directly with local communities and with community ownership. So individual ownership, small amounts, but also community organisations being involved. And that attracts me. It seems to, it's relatively early days, but I'm interested also from an investor point of view, whether the institutional investor community sees that as adding value to them or not, or whether it actually complicates the ownership structure and makes it less attractive. I wouldn't mind an honest answer to that, because clearly in due course, we want scale capital to come into these sorts of regenerative agriculture and rewilding projects and create real natural capital and measure it over time. But you need big money for that, as Darren says, and you also need little money from people who own a piece of it and then feel that they're part of the future.
Any comments? Yeah.
Yes, I'll be interested.
Well, look, I think we can, continue the conversation over drinks. Thanks everybody for your questions. Thanks again to the panel.